In the world of investing, there are names that command respect: Warren Buffett, George Soros, Peter Lynch. But in the shadows, away from the limelight of Wall Street, one man built an empire unlike any other. His name? Jim Simons, a mathematician turned trader who revolutionized the way financial markets operate. His hedge fund, Renaissance Technologies, is perhaps the most successful trading firm in history, boasting returns that make even the biggest Wall Street giants look ordinary. Between 1988 and 2018, the firm's flagship Medallion Fund delivered an astonishing 66% annual return before fees and around 39% after fees, far beyond anything traditional investors could dream of. But how did Simons do it? What was the secret sauce behind his trading empire? Was it sheer intelligence, cutting-edge technology, or something more profound, something the rest of the world is still trying to decode? Jim Simons wasn't your typical Wall Street trader. In fact, for most of his early life, he had little to do with finance. Born in 1938, he showed an early passion for mathematics. He attended MIT and later obtained a PhD from the University of California, Berkeley, by the age of 23. Unlike others who might have pursued a career in business or banking, Simons took a different path. He became a professor at Harvard and later joined the Institute for Defense Analyses (IDA), where he worked on cryptography for the U.S. government during the Cold War. At IDA, he wasn't analyzing stocks or bonds, he was cracking secret codes, decrypting enemy messages, and developing mathematical models that could predict patterns in seemingly random sequences. This experience would later become the foundation of his entire trading philosophy. But Simons was never one to follow orders blindly. He had a rebellious streak. When he publicly criticized the Vietnam War, he was forced out of IDA. With nowhere else to go, he returned to academia and took up a position as the chairman of the mathematics department at Stony Brook University. Yet, something about finance intrigued him. He had a strong intuition that markets, like secret codes, followed hidden patterns. If he could decode military messages using mathematics, why couldn't he do the same for financial markets? This thought was the beginning of something revolutionary. In 1978, Jim Simons left academia and founded his own hedge fund, Monometrics. It wasn't an instant success. In fact, for the first few years, he relied on traditional trading strategies and the results were far from impressive. But then, in the early 1980s, Simons had a realization. He needed to eliminate human judgment from the equation and rely purely on mathematical models. He rebranded the firm as Renaissance Technologies and started hiring an unusual set of employees: physicists, statisticians, cryptographers, and computer scientists. Unlike other hedge funds that focused on economic fundamentals, Renaissance was different. Simons and his team ignored company earnings, balance sheets, and market news. Instead, they built complex algorithms that analyzed vast amounts of historical price data, searching for statistical patterns. And it worked. By the mid-1980s, their models were getting better. They found inefficiencies in the market, small, predictable patterns that most traders overlooked. But this was just the beginning. The real magic would come later with the launch of a fund that would forever change the landscape of trading. By the late 1980s, Jim Simons had found something special. His team of mathematicians, physicists, and computer scientists had built models that could consistently find statistical patterns in financial markets. But Simons wasn't just satisfied with being a successful hedge fund manager. He wanted to create something that had never been done before: an autonomous money-making machine that could trade with almost no human intervention. In 1988, the Medallion Fund was born. It was a fund designed to trade using fully automated, high-frequency strategies, relying on complex mathematical models rather than human intuition. What made Medallion so special? Most investors at the time, including legendary figures like Warren Buffett and Peter Lynch, followed traditional strategies, looking at company fundamentals, analyzing earnings, and making long-term bets. Simons, however, took a completely different approach. Instead of predicting the future based on economic reports or news, Renaissance focused purely on data. Their models analyzed billions of historical price movements, searching for hidden correlations and statistical anomalies. They didn't care why prices moved the way they did. They only cared about the probability that they would move a certain way again. For example, Renaissance's models might have found that when a certain stock index dropped by 1.2% in the morning, there was a 67% chance it would recover by the afternoon. Instead of making subjective decisions, they simply placed trades based on thousands of such probabilities. One of the biggest secrets behind Medallion's success was its short-term trading strategy. Unlike traditional hedge funds that held stocks for months or years, Medallion made hundreds of thousands of trades every day, capturing tiny inefficiencies in the market. They focused on extremely short time frames, sometimes just minutes or even seconds. Their goal was not to make big bets but to exploit tiny edges over and over again. Over time, these small wins compounded into astronomical returns. This approach was so effective that, by the early 1990s, Medallion was making money almost every single year, regardless of whether the market was going up or down. One of the reasons why Jim Simons remains a mystery in the finance world is because he was incredibly secretive. Unlike other hedge funds that published research papers or spoke at conferences, Renaissance Technologies was a closed fortress. Employees were required to sign strict non-disclosure agreements. No one, not even Simons himself, would openly discuss the trading models. The firm never accepted outside money into the Medallion Fund, except from its own employees. By 2005, the fund had become so profitable that Renaissance stopped allowing even its own staff to put in more money. Medallion was simply making too much money, so much that they didn't want more capital, as it could dilute their trading advantage. From 1988 to 2018, Medallion posted an average annual return of 66% before fees, numbers that were unheard of in the investment world. To put this into perspective, if you had invested $1,000 in Medallion in 1988 and somehow avoided the hefty fees, your money would have grown to $23.4 million by 2018. Even after Renaissance's huge fees, 5% management plus 44% performance fees, the fund still returned around 39% per year, which was more than double what even the best hedge funds could achieve. But Medallion's success was not just about luck. It was a mathematical revolution, one that changed how Wall Street viewed trading forever. Jim Simons knew that beating Wall Street required a different kind of thinking. That's why, instead of hiring traditional traders or economists, he built a team of some of the world's best mathematicians, physicists, cryptographers, and computer scientists. These weren't people who had worked in finance before. In fact, most of them had never even looked at a stock chart. But that was exactly the point. Simons believed that traditional finance people were too stuck in their ways. Some of the most brilliant minds that joined Renaissance included Robert Mercer, a computer scientist specializing in computational linguistics, who would later become one of the most influential figures in U.S. politics. Peter Brown, another expert in computational science, who helped build some of Medallion's most powerful trading models. Lenny Baum, a mathematician known for the Baum-Welch algorithm, which was critical in recognizing patterns in data. Henry Laufer, a genius in statistical analysis, who played a key role in refining the fund's predictive models. This group of scientists, engineers, and cryptographers approached financial markets the same way they approached solving complex mathematical problems. They saw patterns, probabilities, and inefficiencies where others saw randomness. Unlike traditional traders who made decisions based on news, emotions, or gut feeling, Renaissance's trading was fully automated. Every trade was executed by algorithms. Human emotions were completely removed from the process. The models continuously adjusted themselves based on new data, learning and evolving in real time. The system was designed to find microscopic inefficiencies that existed only for a short period. And because they traded at high frequency, they were able to profit from these patterns before anyone else even noticed them. Their strategy wasn't just about making the right trades. It was about making so many correct trades that even if some of them failed, the overall system would still be massively profitable. One of the most mysterious aspects of Medallion's strategy is that even its own employees don't fully understand how it works. The algorithms operate inside a black box, meaning that no single person knows every part of the system. Each researcher works on a small section of the model, preventing any individual from fully grasping the entire strategy. This secrecy ensures that even if someone leaves Renaissance, they can't replicate the fund's success elsewhere. This has led to endless speculation. What exactly are these models doing? How do they predict price movements with such accuracy? Many hedge funds have tried to imitate Renaissance, but none have come close. Here's why. Massive data advantage. Renaissance collects and analyzes far more data than any other firm. They look at decades worth of historical price movements, obscure market data, and even alternative datasets that others ignore. Unparalleled computing power. Their algorithms run on some of the most powerful supercomputers in the world. They process millions of variables simultaneously, allowing them to detect patterns that no human or traditional hedge fund could see. A culture of continuous learning. Unlike most firms where traders stick to strategies that worked in the past, Renaissance constantly refines its models. They treat trading like a scientific experiment, testing thousands of new hypotheses every year. Strict secrecy. No research papers, no outside investors, no leaks. Even the firm's employees are bound by lifelong confidentiality agreements. By the early 2000s, Medallion had become so profitable that Renaissance made a shocking decision. They closed the fund to outside investors. Only Renaissance employees were allowed to invest in Medallion. The fund became an exclusive money-printing machine for Simons and his inner circle. This move made sense because Medallion's strategy worked best with limited capital. If too much money flowed in, it would be harder to execute trades without moving the market. By 2010, Jim Simons had become a billionaire many times over, and his firm had cemented its place as the greatest hedge fund in history. But there was still more to come. Before Jim Simons, Wall Street was dominated by two types of investors. Fundamental investors, like Warren Buffett, who analyzed companies' financials and invested based on long-term value. Technical traders, who looked at stock charts and trends to make decisions. Simons introduced something radically different, a purely data-driven, algorithmic approach. Instead of relying on emotions or predictions about the economy, his strategy was based entirely on historical price movements and mathematical models. His success led to a revolution in quantitative finance, and suddenly, every major investment firm wanted to copy his methods. After the rise of Renaissance technologies, many firms started shifting towards quantitative strategies, leading to the birth of a new type of trading, high-frequency trading, HFT. Firms like Citadel, Virtu Financial, and Jane Street started using algorithms to execute thousands of trades per second. Statistical arbitrage. Many hedge funds adopted Simons' approach of exploiting tiny market inefficiencies using mathematical models. Machine learning in trading. With advances in AI, firms began using machine learning to analyze big data and predict market movements. Simons had reshaped finance, but no one could match Medallion's insane level of profitability. While Medallion was making billions every year, Renaissance Technologies launched another set of funds, the Renaissance Institutional Equities Fund, RIEF, and the Renaissance Institutional Diversified Alpha, RITA, Fund. These funds were designed for outside investors and managed far more money than Medallion. However, they never came close to Medallion's returns. While Medallion was returning 66% per year, these institutional funds barely made 10 to 15% per year, which was still great, but nothing compared to Medallion's magic. Then, in 2014, Renaissance ran into controversy. The IRS accused them of using complex options trades to avoid billions in taxes. The firm had allegedly converted short-term trading profits into long-term capital gains, lowering their tax bill significantly. The case dragged on for years, and eventually, Renaissance agreed to pay $7 billion in back taxes and penalties, one of the largest settlements in U.S. history. Despite this, the firm continued to operate at an elite level, and Simons' personal fortune kept growing. In 2010, at the age of 72, Jim Simons stepped down as the head of Renaissance Technologies. However, he remained involved as chairman and continued to benefit from Medallion's massive profits. After retiring, Simons focused on philanthropy and scientific research, donating billions to the Simons Foundation, supporting math and science research, autism research, funding initiatives to understand and treat autism. Stony Brook University, his alma mater, where he invested heavily in education and scientific discovery. Even though he stepped away from active trading, his influence on modern finance, machine learning, and algorithmic trading remained stronger than ever. Jim Simons didn't just beat Wall Street, he changed how trading works forever. His quantitative approach has inspired thousands of firms, but none have been able to replicate Medallion's insane profitability. His story proves that numbers don't lie. Data-driven investing can outperform even the smartest human traders. Secrecy is power. Keeping proprietary trading strategies hidden is crucial for long-term success. The future of investing is AI-driven. As computing power grows, markets will be dominated by algorithms, not humans. Jim Simons' story is not just about building the most profitable hedge fund in history, it's about changing the way we think about money, markets, and investing. Here are the most important lessons from his journey. 1. Data always wins over emotion. Most investors make decisions based on gut feeling, news, or market trends. Simon's proved that a purely data-driven approach is far superior. He removed human emotions from the equation. He let math and algorithms make trading decisions. He trusted patterns in data more than economic predictions. For everyday investors, this means one thing: stick to a system. Whether you use index funds, value investing, or any other strategy, don't let emotions dictate your moves. 2. Surround yourself with the smartest people. Simons didn't rely on Wall Street professionals. Instead, he built a team of mathematicians, physicists, and computer scientists who thought differently. He believed that intelligence from other fields could be applied to finance. His team approached investing as a problem to be solved, not a game of predictions. They constantly improved their models, testing thousands of theories each year. If you want to succeed in business, investing, or life, hire the smartest people even if they don't have traditional experience in your field. 3. Keep your advantage secret. One reason Medallion remained so successful is that no one outside of Renaissance truly understands how it works. Employees were only given access to small parts of the system. The fund was closed to outsiders to prevent leaks. Even after Simons retired, the strategies remained a mystery. If you have a business or investment strategy that works, protect it fiercely. The less people know, the harder it is for competitors to copy you. 4. Small edges compound over time. Medallion didn't make money by finding one big market inefficiency, they made money by finding thousands of tiny ones. They executed millions of trades, each with a small statistical advantage. Even if they were right only 51 to 55% of the time, over thousands of trades, it added up to billions. They didn't care about market crashes or booms, they made money in all conditions. For investors, this means that small, consistent gains add up over time. You don't need to hit home runs, just keep winning more than you lose. 5. Timing the market is almost impossible. One of the biggest myths in investing is that you can predict when to buy and sell. Even legendary investors struggle with market timing. Renaissance never tried to predict anything, they just followed the data. Their algorithms adapted in real time to new information. For long-term investors, this means time in the market is more important than timing the market. Where's Renaissance Technologies today? Even after Simon's retirement, Renaissance Technologies continues to dominate. Medallion Fund still generates astronomical returns, though it remains closed to outside investors. Other quant funds like Citadel, 2 Sigma, and D.E. Shaw have tried to copy Renaissance's model, but none have matched their success. The rise of AI and machine learning in finance has been directly influenced by Simon's work. While Jim Simons passed away in 2024, his legacy lives on in modern finance, mathematics, and philanthropy. Final thoughts: can anyone replicate Jim Simons' success? The truth is, there will never be another Jim Simons. His success was a combination of intelligence, secrecy, and timing. Medallion's models are likely far ahead of anything available to the public. Even with AI and big data, most investors will never have access to the kind of resources and computing power that Renaissance uses. However, we can all learn from his approach. Use data, not emotions, to make financial decisions. Focus on small advantages that compound over time. Stick to a proven system even when the market is volatile. Surround yourself with the smartest minds even if they come from outside your industry. Jim Simons didn't just beat Wall Street, he rewrote the rules of investing. His story is proof that, in a world where everyone follows the crowd, the real winners are the ones who think differently.